Most people assume banks profit primarily from the interest charged on loans. That's partially true, but it's not the primary mechanism behind the system. The real money isn't made when you first borrow from the bank. It's made while you carry that balance month after month after month. In 2023, the average American household held roughly $6,000 in credit card debt. Not because of a single large purchase that pushed them over the edge. Because of accumulation, small balances that never quite reach zero each month. Banks don't need you to borrow more money than you already have. They need you to stay in, revolving, paying minimums, maintaining the relationship. There's a financial product most people use, but very few actually understand fully. The credit card, presented as convenience, a tool for daily transactions, a way to buy now and pay later without carrying cash everywhere. And for decades, that's exactly how the product functioned in the economy. But something shifted in the structure between then and now quietly. The product didn't change. Plastic cards still worked the same physical way. The incentive structure did. What banks optimized for became fundamentally different. In the 1980s, total credit card debt in the United States was around $50 billion. By 2024, that number had grown to exceed $1.1 trillion across American households. Not because people suddenly needed more things or lived more extravagant lives, because the system became better at keeping balances active, alive, and growing slowly. Here's what most people believe happens when they use a credit card. You swipe, the bank pays the merchant, and you pay the bank back. Simple transaction, a temporary loan that gets repaid within the billing cycle. And if you pay in full each month, that's exactly what happens. But only about 35% of cardholders pay their balance in full every month. The other 65% carry a balance paying interest on what remains unpaid. That's where the fundamental shift in the business model becomes visible to observers. Banks don't make most of their money from people who pay in full. They make it from the revolvers, people who carry balances month to month. And the longer you carry, the more the relationship becomes profitable for them. Let's say you have a $3,000 balance on a card with 22% interest. If you pay the minimum, usually around 2% of the balance, monthly, that minimum payment on $3,000 would be about $60 in the first month. Of that $60, roughly $55,000 goes to interest, and only $5 reduces the principal. At that pace, it would take you over 30 years to pay off the debt, and you'd end up paying more than $10,000 in interest on that original $3,000. The bank didn't need you to borrow $10,000 to make $10,000 from you. They just needed you to carry $3,000 for a very, very long time. This is the mechanic most people don't see when they think about debt. It's not the size of the loan that matters most to the lender. It's the duration, how long the balance stays alive on the books. In Luxona Vault, we follow what happens when duration becomes the primary product. How minimum payments are calibrated not to help you escape, but to keep you in. How the math is designed so that paying feels like progress while the total barely moves. But there's a second layer that makes this system even more efficient for banks. It's not just that you're paying interest on the debt you carry over time. It's that the debt itself keeps you connected to the system perpetually, indefinitely. Every month, you receive a statement reminding you that you owe something back. Every month, you make a payment, reinforcing the habit, the relationship, the routine. You become a recurring revenue stream, not a one-time customer who borrows and leaves. This is why banks offer rewards, cashback, points, travel miles, exclusive benefits. Not to help you save money, but to make sure you keep using the card. The more you swipe, the more likely you are to carry a balance eventually. And once you carry, the rewards you earned are dwarfed by the interest you'll pay. A 2% cash back card sounds appealing when you pay your balance in full. But if you carry even a small balance at 20% interest for months on end, the math inverts. You're giving back 10 times what you earned, but it happens slowly, so it feels manageable. This is the quiet efficiency of the model. It doesn't feel predatory in the moment. It feels like flexibility, like breathing room, like a bridge between paychecks or months. And that's exactly what makes it so effective at keeping people inside the cycle long-term. There's a reason banks send you pre-approved offers in the mail constantly, repeatedly. A reason they increase your credit limit without you asking for it at all. They're not rewarding responsibility. They're expanding capacity for you to carry more debt. Because a customer with a $5,000 limit who carries $2,000 is moderately profitable monthly. A customer with a $15,000 limit who carries $6,000 is far more valuable over time. The limit increase isn't about trust, it's about increasing the potential revenue per customer. And here's where human behavior enters the equation in a way that's hard to avoid. When your credit limit goes up, spending often creeps up with it over months and years. Not dramatically, just enough to make the new limit feel normal, reasonable, justified. Psychologists call this mental accounting. We don't treat all money the same way cognitively. A dollar in your checking account feels different than a dollar of available credit on a card. Available credit feels less real, less immediate, less like it's actually leaving your possession permanently. So you spend it more freely, not recklessly, just with less friction than you'd spend cash. And that friction is the difference between paying in full and carrying a balance forward monthly. Banks know this. They've studied spending behavior for decades with enormous precision and data. They know that higher limits lead to higher balances, and higher balances mean longer durations carried. And longer durations mean compounding interest, and compounding interest means profit margins expanding steadily over time. This is why the credit card industry is so stable despite economic ups and downs. Because even in recessions, people still carry balances. Sometimes they carry more than ever. The product doesn't depend on you thriving financially. It depends on you staying connected consistently. In traditional lending, the bank wants you to pay off the loan as agreed quickly. In revolving credit, the bank wants you to pay just enough to stay in good standing. Not too much that the balance disappears, not too little that you default and disappear entirely. The optimal customer pays reliably, carries consistently, and never quite reaches zero balance again. This is where we slow down on Luxona Vault and follow the incentive deeper still. What happens when banks realize the most profitable customer isn't the biggest borrower at all? It's the one who remains in a permanent state of manageable debt for years or decades. Because that customer isn't just paying interest, they're generating predictable, recurring, compounding cash flow. They're an annuity, a financial instrument that pays out steadily over time without significant risk. And annuities are among the most valuable assets any institution can hold on their balance sheet. This is the real reason banks want you in debt, not crisis debt, but comfortable debt. Debt that doesn't feel like an emergency, just a fact of life you manage monthly without panic. Debt that you pay down occasionally, but never fully eliminate because something always comes up again. A car repair, a medical bill, holiday spending, back-to-school costs, unexpected travel, life itself. The balance dips, then rises, then dips again, but the average over time stays relatively constant. And as long as it stays constant, the revenue stream from your account remains steady and predictable. You're not a customer anymore, in the traditional sense of someone who buys something once. Your infrastructure, a recurring line item in the bank's revenue model projected years into the future. And the system is designed so well that most people never feel trapped by it at all. They feel like they're managing, making payments, staying current, keeping their credit score healthy and intact. Which is true, you are managing, and that's exactly what the system needs you to do. Not escape, not default, just manage month after month, year after year, indefinitely. There's a third mechanism that makes this model even more resilient over time than most realize. Banks don't just profit from the interest you pay on the balance you carry each month. They also profit from securitization, bundling your debt with thousands of others and selling it. Credit card debt gets packaged into financial instruments called asset-backed securities, or ABS for short. Investors buy these bundles because they generate steady income from all the interest payments flowing in. Your monthly minimum payment isn't just going to the bank, it's feeding a much larger system. This means your debt has value to the bank even before you pay it back. They can sell the rights to your future payments and receive cash upfront immediately. Then they use that cash to issue more credit cards to more people who will also carry balances. The cycle feeds itself. Debt creates financial products, which create capital, which creates more debt. And the engine only runs efficiently when people remain in the system, paying consistently over time. When we extend this on Luxona Vault, we trace how securitization changed lending incentives permanently across decades. How banks shifted from lend carefully to lend widely because the risk could be packaged and sold. How your relationship with debt stopped being bilateral and became part of a global financial loop. But here's what makes the current system different from anything that came before it historically. In the past, debt was stigmatized, something you took on reluctantly and paid off as quickly as possible. Today, debt is normalized, woven into how you build credit, buy homes, fund education, and live daily. You're taught that some debt is good debt, and using credit responsibly helps your future opportunities. Which is true in the narrow context of credit scores and loan approvals down the line. But it also trains an entire generation to see revolving balances as normal financial behavior permanently. Credit scores themselves are part of this. They reward you for using credit and maintaining accounts actively. If you never use credit, your score suffers because there's no history to evaluate or judge. So the system incentivizes participation, and participation makes carrying balances statistically more likely over time. The average American has about 4 credit cards in their wallet at any given moment today. Not because they need 4, but because the system encourages it through rewards and optimization strategies. 1 card for gas, 1 for groceries, 1 for travel, 1 for everything else with rotating categories. Each card becomes another relationship, another statement, another balance to track and manage monthly. And the more cards you have, the more opportunities there are for one of them to carry a balance. This is the architecture of modern consumer finance, not a single trap, but many small frictions. None of them individually feels dangerous or life-altering in the moment you engage with it. But together, they create a system where staying in becomes easier than getting out over years. And that's the brilliance of it. From the bank's perspective, it doesn't rely on deception anymore. It relies on convenience, on rewards, on normalization, on the path of least resistance over time. You're not tricked into debt. You drift into it, one purchase at a time, 1 month at a time. And once you're in, the system is optimized not to pull you deeper, but to keep you exactly where you are. Because the customer who stays at a manageable balance for 10 years is more valuable than the customer who borrows big and pays off quickly. Stability beats intensity in this model. Slow, steady revenue beats volatile, unpredictable spikes every single time. So when you get that notification that your credit limit has been increased without asking for it, pause. When you see a new credit card offer with a higher cashback rate than your current one, pause. When your minimum payment feels affordable, even though your balance hasn't moved much in months, pause. Not because the system is trying to ruin you, it's not that dramatic or personal at all, but because the system is designed to keep you comfortable, connected, and paying indefinitely without much thought. And comfort in this context isn't the same as freedom. It's the opposite, disguised as flexibility. Welcome to Luxona, the Netflix of finance.